As the market is currently closed on this Sunday, July 5th, 2026, we are looking back at the last official trading session from Thursday, July 2nd, 2026 at 4 p.m. Eastern Time, where ONDAS Holdings closed at exactly $7.41 per share, marking a significant drop of 6.44% for the day. While the surface narrative around this move paints a picture of standard sector-wide weakness, the hidden reality is that big institutions are quietly rewriting the playbook on how they value high-growth infrastructure technology. While the crowd is panicking over everyday fluctuations, the underlying numbers reveal a massive divergence between what the public thinks is happening and what the institutional balance sheets actually show. This creates a critical setup for anyone using a modern individual brokerage to navigate volatile tech names. The common consensus among retail traders right now is that this firm is just another speculative small-cap drone play caught in the crosshairs of a broader market pullback. When you look at popular online investing platforms, the sentiment seems to be driven by fear of dilution and capital raises. Investors look at their favorite investing sites and see a company asking to expand its authorized share capital to a massive 1.2 billion shares, and they immediately assume the worst. They see the recent sell-off alongside massive hardware and chip giants, assuming that if major tech components are struggling, a micro-cap drone and wireless network operator does not stand a chance. But the reality running beneath the surface tells a completely different story, one that challenges the fearful narrative found across major online investment forums. What casual observers miss is that the company is currently sitting on a massive $457 million pro forma backlog, fueled by a series of aggressive, highly strategic acquisitions, including the $175 million Mistral merger and the recent $125 million acquisition of Cyberhawk. While retail portfolios are dumping shares out of fear, the underlying business is actually projecting full-year revenue for 2026 to reach at least $390 million. This massive gap between market perception and actual commercial backlog is exactly the kind of structural inefficiency that sophisticated players look for when doing their self-investing research. To understand why this gap exists, we have to look closely at the trading volume and recent institutional footprints that characterized the late June and early July sessions. The trading volume spiked to a massive 87.14 million shares during the July 2 decline, which is significantly higher than its three-month average of roughly 68 million shares. This volume surge did not happen in a vacuum. It occurred right around the time of the Russell 2000 and Russell 3000 index reconstitution, which forced passive fund managers to rebalance their positions. When passive index funds are forced to buy or sell large blocks of shares regardless of valuation, it creates temporary distortions that active traders using an interactive brokers platform can exploit if they understand the mechanics of index inflows. If you look at the options market for the stock, the implied volatility has been hovering near 83%, suggesting that professional market makers are pricing in massive swings over the next few months. This is very different from standard blue-chip equities, where volatility is tightly managed. For instance, an investor tracking Tesla stock, Apple stock, or Nvidia stock is accustomed to high options liquidity but relatively predictable institutional trading bands. With a stock like this, the price action behaves more like an early-stage biotechnology setup, where a single contract win or regulatory approval can shift the valuation overnight. People managing their holdings through an automated intelligent portfolio or specialized products like Schwab Intelligent Portfolios often miss these micro-cap nuances because standard algorithms tend to group all defense and drone technology into a single broad category without looking at specific contract structures. Let us look at how the company got to this point to see where the tension between expectation and reality truly lies. The core business model operates through two primary divisions, ONDAS Networks and ONDAS Autonomous Systems. The network side provides high-reliability proprietary wireless data networks for critical infrastructure, such as major freight railroads and oil field operations, where standard cellular networks are simply not secure or reliable enough. The autonomous systems side comprises their drone platforms, specifically the American Robotics and Aerobotics roll-ups, which provide fully automated drone-in-a-box solutions for industrial monitoring, defense, and homeland security. Their recent Q1 earnings report shocked the street when revenue hit $50.1 million, representing a tenfold increase year over year, while beating earnings per share estimates by a wide margin. Despite these spectacular operational wins, the stock has faced intense downward pressure from its 52-week high of $15.28 down to its current level. The primary culprit is the overhang of share dilution. Building out a global drone infrastructure footprint requires immense upfront capital, and management has chosen an aggressive roll-up strategy, completing 6 separate acquisitions this year alone. Each acquisition involves issuing new shares, which dilutes existing stockholders and creates constant selling pressure as target company insiders liquidate their newly received equity. This dynamic has left many casual retail investors who use a Robinhood app or basic Robinhood stock trading accounts feeling frustrated as they watch the business grow operationally while the stock price keeps sliding. Comment below how many shares of ONDAS holdings you currently hold in your portfolio right now. Hearing from you helps gauge whether retail support is still strong or if folks are moving their capital into more traditional large-cap names. When you look at the institutional landscape, the ownership structure is remarkably divided. Mutual funds and equity-traded funds hold roughly 17.5% of the outstanding shares, while other institutional investors control nearly 23%. The remaining 59.5% belongs to public and retail investors. This high retail concentration explains why the stock is prone to sharp sentiment-driven swings. When bad news hits the tech sector, retail investors tend to liquidate their speculative small caps first to protect their core holdings. This creates a cascading effect where a downward move is amplified by panic selling rather than a deterioration in the actual business fundamentals. For someone looking for investment help or trying to decide if this fits into their self-investing strategy, the choice comes down to how you view the timeline of industrial autonomy. The company's SentrySeas subsidiary recently partnered with Lockheed Martin's Sanctum platform to provide advanced counter-drone solutions. In the current global defense landscape, counter-drone technology is seeing unprecedented demand. If these pilot programs convert into long-term procurement contracts, the current $457 million backlog could easily double over the next 12 to 18 months. This is the catalyst that the bulls are banking on, believing that real revenue growth will eventually outpace the dilutive effects of the share expansions. However, the risk side of the ledger cannot be ignored. If the company continues to issue equity to fund its operations without achieving positive net cash flow, the share price could continue to compress, forcing a potential reverse split down the line to maintain its NASDAQ listing requirements. Traders using a comprehensive fidelity brokerage or advanced interactive brokers trading software need to closely monitor the upcoming quarterly reports to see if the cash burn rate is beginning to stabilize. If management can prove that they no longer need to tap the public markets for dilutive capital raises, the sentiment could flip dramatically. When we weigh the current reality against market expectations, we see a business that is growing at a breakneck pace structurally, but suffering from severe growing pains financially. The broader market expects immediate profitability, whereas management is playing a long-game land grab in the industrial drone space. This contrast is exactly why the stock remains highly polarized on social media and financial forums alike. Whether you use sophisticated tools like Fidelity Wealth Management or trade casually on a mobile app, this stock requires a clear understanding of risk management. In conclusion, the central insight here is that the recent drop to $7.41 reflects a market focused heavily on the near-term friction of share dilution and sector rotation, rather than the long-term asset accumulation of the firm. The expectation was a continuous rally driven by a tenfold revenue surge, but the reality is that aggressive corporate expansion has its costs, and the market is making the company pay that tax right now. As we move deeper into the second half of 2026, the success of the Cyberhawk and Mistral integrations will ultimately determine whether this drop was a historic buying opportunity or a warning sign of an overextended roll-up strategy. Keep your eyes on the backlog numbers and the authorized share votes in the coming weeks to stay ahead of the next major move.